What's interesting is the backdrop to the global trade conversation. We were in that global synchronized growth recovery story, but now if you take a look at trade flows, we've actually turned negative. Kathryn, walk us through the macro backdrop here.
Yeah, I mean, trade flows are definitely what's causing fear in the markets at this point. I would say that markets are pricing in the worst, especially in emerging markets. There's several headwinds that we all know what they are, and I think that they are largely already priced in. So you can find attractive valuations in the emerging market space, I would contend, right now. And I think it's a good place for a lot of investors, both institutional and retail, to start accumulating positions if they don't have them already.
Kathryn, there's an awful lot of talk about trade right now in all the markets. Is the issue the underlying substance of the transactions, or is it actually the effect on sentiment? Bloomberg just interviewed the former head of the PBOC, who said really it's a sentiment issue. It's not really how much trade is going to be affected.
It's all sentiment. I think your question is dead on, David. It's all sentiment. So emerging markets are getting smacked around because of sentiment. Trade is the fears of a trade war. We're talking about a trade war, but de facto, it's semantics, but do we really have one at this point? We don't see higher inflation yet. We don't see impact on economic growth. U.S. growth is extremely strong. So I would contend that it is at this point sentiment, and I think that a lot of this trade banter has to do more with negotiation and working out a deal than truly the intention to bring about global trade war.
However, if you take a look at inflation pass-through, there are some worries, and Apple front and center. Over the weekend, there was a letter to basically President Trump saying that our concern with these tariffs is that the U.S. will be hardest hit, and that will result in lower U.S. growth and competitiveness and higher prices for U.S. consumers. They're raising their prices for things like the Apple Watch and AirPods. How do you then factor in something like this to your overall risk thesis?
Sure. I mean, if we get a scenario where China does, in fact, put tariffs on the majority of the most important goods that we in the U.S. consume, or vice versa, if there is a trade war on the most important goods that people actually use, then we're going to see higher prices, undoubtedly. And I think that's what the real concern is. Is that the ultimate end game? That's what the market's trying to figure out right now. As we've all seen, every time the market has been spooked by a trade war, it's been an opportunity to buy. So at the end, what are the Chinese and the U.S. negotiating at this point? My understanding is that the U.S. is now looking for more structural changes from the Chinese side, which is less protection of their domestic goods, which I think could be even more trickier than just trying to open up to the import of U.S. cars or whatever.